In 2024, India has dominated the IPO market. There have been 227 issues totaling to approximately $12 billion. In fact, in Asia Pacific, India is at #1 spot as far as IPO market is concerned. Hi, I'm Harish Thakkar. We're going to be talking about the equity issuance today, primarily the IPOs and then the secondary market as well. Today we are going to be talking about the issuance process as far as equity is concerned. In the previous sessions we have talked about equity as an instrument. Today the focus is going to be the capital as such, the share capital and the issuance and the trading aspect of it. So before we get to the equity issuance process, let's get started with the share capital. Now, I might want to take you back to your academics, particularly commerce students, where when we learned equity as an instrument, the instrument as such, the characteristic of an equity instrument is that it's forever. A company has a perpetual existence, which means that when an equity is issued, you cannot give it back to the company, or the company does not buy it back unless of course it's a corporate action, or unless of course the company wants to do it. So where is it that the equity can be bought or sold? The obvious answer, and most of you would know it, are the stock exchanges. Today we'll go through this entire process of what is share capital, the equity as an instrument being issued to the public, and finally the trading aspect of it on the stock exchanges. Let's get started with the share capital. The share capital is the capital, the amount of money with which a company runs its business. So it's the total value of shares issued by the company. It represents ownership interest that the shareholders have in the company. Now the question is, how much capital, or how much capital can they issue? This is mentioned in the Memorandum of Association. The authorized share capital is what I'm referring to. So the companies have a capital, a maximum amount of share capital that they are legally allowed to issue. That's your authorized share capital. So a company may want to, in its Memorandum of Association, state an X amount, let's say for example 100 million as their authorized capital, but they may not always and in most cases issue it all at one go. They might just want to issue a part of it, taking into consideration their immediate short-term, medium-term and to some extent even long-term requirements, and issue it to that extent. So out of the 100 million, if they choose to issue a part of it, let's say 50 million, and I'm just taking this as an example, that's your issued share capital. The issued capital is basically the portion of the authorized share capital that the company has actually sold it or issued to the shareholders. It represents the ownership interest held by the shareholders at that specific point of time. Obviously, the other 50 million is still unissued and remains there as an authorized share capital. Now, when the company is issuing a share capital, it may not always want to take all the money. So if, again, taking this into an example, so if the issued capital is, let's say, 50 million and the face value of the share is, let's say, only 10, so it's issuing 5 million shares of 10 rupees each, the company may call for only a part of it, or it may actually get the part of it, the money that is received as the paid up capital part of it. So it's the amount of money by the company that is received when it sells its shares to the shareholders. The investors put in money, buy those shares, and that constitutes the paid up capital for the company. So basically, let me just kind of compare the two in terms of authorized versus the paid up capital. The authorized capital, as I had mentioned it earlier, is the maximum amount of capital that the company is legally allowed to have, whereas the paid up share capital is the actual amount, and as the word itself is suggesting, the paid up capital, the paid by the shareholders for the shares that they are holding. If the authorized capital needs to be increased, then that requires authorization in the memorandum of association. The paid up capital, however, can be increased by coming up with further issues, so the company can do that far more in an easier way than the authorized capital. The authorized capital has nothing to do with the net worth calculation because it's a maximum amount and includes the unissued part as well. However, the paid up share capital comes into play when you are calculating the net worth of the company. There are certain limits as far as private limited companies and public limited companies are concerned as far as authorized capital is concerned. That of course depends on the jurisdiction and the country. But of course the paid up capital is always going to be less than the authorized capital. As far as the issuance restrictions are concerned, as I had mentioned earlier, this is the maximum allowable capital, the authorized capital. Hence, the company cannot exceed that limit. But paid up capital being a part of the authorized, the paid up capital can be increased, can be further issued, but to the extent of the authorized share capital. Now let's get started in terms of the issuance aspect of it. Let me give you a quick overview of the primary market and the secondary market, and then we'll dwell deeper into both of these as a full-blown session. So the primary market is the first time issuance of the capital to the investors. It's the first time that the company wishes to part with its shares, the ownership, and issues shares to the investors. This could be by way of offer for sale or IPOs, and we'll talk about these in far more details as we go along. The secondary market, on the other hand, is the subsequent buying and selling in those equity shares, which means the first time around, the first sale that took place between the company and the first time investor was the primary market, and all the subsequent buying and selling that takes place is nothing but the secondary market. We've already talked about the functions of secondary market being the liquidity and the price discovery. We will talk about it in far more detail as we go along. So let's get started with primary markets, and we are going to talk about offer for sale and IPOs. Okay, so let's get started with offer for sale. What is basically offer for sale? Now, when a company, there are shareholders, there are founder members, there are existing promoters and large investors. When they decide to sell their holding, essentially it's basically an exit route for the large investors as well, and primarily that's a very big reason for coming out for offer for sale. But when the existing promoters and large investors decide to sell a part of their holding, or in case of large investors even the entire holding, to the public, this issue is, although a primary market, but nothing but an offer for sale. So in such a case, the company needs to comply with the regulatory requirements in terms of coming up with certain disclosures, certain mandatory requirements as specified by the regulatory authorities, and then come up for offer for sale. The first process is once the regulatory compliances are done and permissions are achieved, the appointment of intermediaries. Now let's understand this in a more simplified way. A company it's into a core business. Let's say a company called as, let's take Zomato, yeah, for the sake of example. The company is a platform basically for food delivery and so on. It needs to have an agency that will take care of this entire issuance process, this offer for sale process. And these are typically the investment banks that help organizations raise capital. So a Zomato, once it decides to come up with an offer for sale, will appoint intermediaries. Then the question comes, at what price? So what is the company really worth for? So it's not just the current net worth of the company, but also future earnings or the potentials or the order book. So there are multiple considerations as far as price determination is concerned, which again the investment banks, the intermediaries help determine the price. And finally, then it's about who are you really selling it to. There is some regulatory requirement in terms of while the participation is by both the retail as well as the institutions. That is, when I say institutions, I'm referring to mutual funds, pension funds, insurance companies and so on. But there is certain percentage that is earmarked for retail, for certain institutions and so on. So it's determination of how much participation by both retail as well as the institution. And then comes the application or the bidding process part of it and the allotment part of it. Yeah, I'm just kind of giving you an overview here, but we will talk about it, taking as an example a recent IPO and an offer for sale, and discussing these in detail. Once the allotment of shares is done, the question is, the retail or the institutional buyer, shareholder now, where does it have the opportunity to sell if they want to exit? Yeah, the company is out of the process. They have sold these shares to the retail and the institutional buyers. So there needs to be a marketplace, which is nothing but your stock exchanges, and that process is nothing but listing of those securities. Finally, and again, then the trading takes place, and those trades done on the exchanges need to be settled. Once these settlement is done, the post offer for sale, the ownership obviously changes. In the pre-OFS stage, the promoters had a larger percentage. Now they've offloaded certain percentage, so their ownership as such decreases to some extent, and the new ownership structure is then comes into play. On the other hand, so in offer for sale, we had the owners or the promoters, the large investor, kind of selling their ownership rights or their holdings to some extent. What if the company wants to go beyond that and offer additional shares, increase the capital, which is nothing but your IPO? Here again, the process largely remains the same, and there are certain different ways of actually issuing these shares, which we will talk about it in the subsequent slides. And there are two types essentially. One is the fixed price issue, and the other one is the book building issue. The fixed price issue nothing but means a fixed price, a pre-decided price at which the company says okay, and as an example we say let's say the face value of the shares is 10, given the company's net worth, the earnings and the future earnings, says okay, we are going to issue these shares for 25 rupees. So a 10 rupee face value gets issued at 25. This 25 this is fixed, this is pre-decided, and that's the price that the investors, if they wish to subscribe the shares for, have to pay for it. So it's a fixed price issue, and it's mentioned in the offer document alongside all the other disclosures as such. The book build issue, on the other hand, is actually a mechanism by way of which, keeping in mind the demand and supply, a price is arrived at during this process based on the bids received from the investors. So if I were to take that same example and explain this, the 10 rupee face value share in the fixed price IPO was issued at 25, but in the book built issue, the company says that we are going to keep a range to say that the shares can be issued anywhere between, let's say, 22 and 29 or 28, and I'm just making this up at this point. Let the investors decide what price they want to pay. As an investor, obviously they would want to buy shares at the lowest level or the cheapest price, but the company says no, there is a fair value, or there's a base price, or there's a floor price that's decided. So 22 becomes the minimum price, and there is a higher band, which in our example I said 28 or 29, so that's your cap price. So it's the range within which the investors have to bid for. So that's the difference between, so basically that's the difference between a fixed price IPO and a book built IPO. Now let's get to the process. We had talked about it that appointment of intermediaries becomes the first part, because company as such, the core business is not really into issuances of capital and so on. It's into a completely different business. We took the example of Zomato. So the company appoints intermediaries called as the lead merchant bankers, and most cases are these investment banks that offer these services, and they are the ones who are called as the book runners, or the ones that actually handle this entire process. Now in most cases there is no one investment bank that handles the entire IPO. There are multiple investment banks, merchant bankers involved in this entire process. Hence you have all of these members being called as a syndicate of members. As again, the price which has been a fixed price or a book built issue, the investors are asked to specify the price at which they would want to buy these shares, and all of this entire prices and the quantity is all collected and put into one system. This process normally takes about 5 days, and based on the applications received, the decision is made in terms of at what price. And as you can see in this example, the floor price was 20, the cap price was 24, and as an example, we've just to kind of simplify it, taken only 3,000 shares. The company has received multiple bids from the bidders, and the subscription at 22 seems to be the highest in terms of the number of shares or the bid quantity. Based on all of these parameters, and frankly there are other considerations as well, and based on all of this, and we are at this point, and for the purpose of this session, not getting into the technical details of it, but largely the company looks at the bids, the price at which those bids are coming in for, the maximum or the cumulative bid quantity that has been bid at that particular price, and after taking into consideration all of these factors, a price is determined, and that's the price which is nothing but your cutoff price. In fact, the company also provides a mechanism or a part where you can only specify an amount, that's the price that you're willing to pay for, or you can also use the word cutoff, that whatever is the cutoff price which is ultimately decided by the company, that is what you're willing to pay. So this becomes the final price at which the shares are sold. And I'm going to take an example which is a very great example, a very recent IPO. I'm sure most of you would have at least heard about it, if not invested or applied for. And if you've applied for it and allotted some shares, then I'm sure you're one of the lucky few who managed to get an allotment of this particular share. So it's, yes, Bajaj Housing Finance that I'm referring to. So in this case, and this is a good example because this was a combination of offer for sale as well as IPO, and hence I thought it's a good example to have. So let me just put certain details. So the total issue size was about 6,560 crores, and as you can see, the fresh issue part of it, that's over and above the offer for sale, was 3,560, and offer for sale was 3,000 crores, where the promoters were offloading certain part of their ownership. So the shares, the face value was 10 rupees per share, and here the price band was 66 to 70, and the book built issue was undertaken by the lead managers, and I'm just giving certain names here. These are the leading lead managers in the country. 7 of them handled this particular issue, and the entire process, let's just go through in a little bit of more detail, keeping in mind maybe Bajaj Housing Finance. So the issuer, that is the company, appointed the merchant bankers, legal advisors, RTA. RTA is nothing but registrar and transfer agents. These are the ones who actually maintain the register of shareholders, because post the issues there are going to be thousands and lakhs of investors, so they are the ones who maintain the register of members. Syndicate members, we've already talked about it. Underwriters are the ones, and in this case, or in most cases actually, the underwriters are the investment banks. Underwriter as such guarantees subscription to the issue. Basically means that if there is a shortfall in applications and there are less investors, the investment banks will guarantee subscription. They underwrite the shares. So once the appointment is done, the due diligence takes place in terms of compliances, the legal and the regulatory requirements are complied with, and then the company as such files a red herring prospectus with the regulatory agencies. And once that is done, you receive an in principle approval from the stock exchanges that once the issue is done, the listing will take place on the stock exchanges, and in this case it was the National Stock Exchange and the Bombay Stock Exchange. The issue price, the price band as such, and the dates are decided. This was in the case of Bajaj Housing Finance, September 2024. And once the entire process is done for 5 days, application received, and we've talked about the way the cutoff price is decided, all of that done, and the shares are issued, the post-issue compliances are done, issues is closed, and the entire register of members is now with the RTA agents, and the listing takes place on the stock exchanges. That's when the trading will begin. So we've understood the two basically ways of primary market issuances, which is nothing but your IPO and offer for sale. And what I'm doing here is to kind of distinguish between the two, just to kind of summarize the two and get our understanding right in terms of what are the differences between the two. So an IPO is the first time issuance, of course, but it's a fresh issuance. Yeah, the offer for sale is nothing but the providing the liquidity to the existing shareholders, the large investors, promoters, founding members, and so on. So they part with their holding to some extent and offer it to the public for subscription. Of course, there's ownership change. In case of IPO, the ownership structure will change because the issued capital is now going to get a bit more because it's a fresh issue. In case of offer for sale, the structure, the amount of share capital remains the same because it's only the ownership that has changed from a large investor to a retail investor. But otherwise, the number of investors will increase, but the share capital will not increase. Regulatory requirements are, of course, to be complied with in both the cases. However, in IPOs, it's slightly more because it's a fresh issue, needs to be far more detailed and so on. But largely, the process does involve a lot of regulatory requirements that need to be complied with. The fund utilization as such, this is a good distinguishing factor in the sense that in the fresh issue, the company is increasing its issued capital and coming up with additional shares. Hence, the funds that get collected from the participation, the retail participation, go to the company as such. In offer for sale, on the other hand, it's the promoters, the large investors who have sold their shares, which means they get the proceeds of the issuance that has taken place. So that's a very important distinguishing factor between the two. Again, type of company, well, IPOs are associated with private companies which as such have been privately held but now wanting to go public and getting retail participation or public participation as such. OFS, on the other hand, could be publicly traded. There are already large investors and they have decided to offload their holding to larger public or retail as such. So that's basically the difference between IPO and OFS, and with that we've kind of come to an end of as such the primary market part of it. Now we're going to look at the secondary market equity issuance. Let's now try and understand secondary markets. We've already established what are secondary markets. So secondary markets are nothing but a platform, a market where buyers and sellers come together and trade in those securities. The investors who had purchased shares from the primary market may want to exit and book profits. On the other hand, there can be new investors who have interest or may not have been issued shares when they had applied in primary market but may want to buy now. So the secondary market provides an opportunity, a marketplace, a platform where buyers and sellers come together and trade in those securities. So essentially the trade happens between the investors. Company is out of the picture as such. The company has issued shares to the investors by the route of primary market, and now it's the investors who are trading or buying and selling amongst themselves and either exiting the share or investing in those securities. The very purpose of secondary market is liquidity. An equity instrument as such, you cannot go back to the company and there is no redemption as such. The shares cannot be redeemed by the very nature of the instrument. Hence, the investors need a platform or an exit route if they wish to sell those securities and discontinue their investment. The stock exchanges or the secondary market for that matter provide that liquidity to the investors. The main functions of the secondary market are investment, maintaining liquidity, price discovery, risk management, and low cost. We'll talk about each of these in detail. So, when you talk about the secondary market, the functions as such, the secondary market basically depicts the state of the economy. Let me simplify it. If I were to say that an economy, whether it is doing well or not doing well, can be understood by the companies from various sectors. Are they really making profits? Are they doing well? So collectively, if all industries are doing well, then we can say the economy is doing well. But how do you understand whether all the industries are doing well? If you look at the secondary market, and if the stock prices of all of these companies or a larger part of it are increasing or doing well, hence it can be construed that the industries are doing well and consequently the economy is doing well. Again, if you look at the stock price, the secondary market provides the price discovery. It basically comes in at a point where the demand and supply meet and the share is traded at that particular price, which is an indicator as such in terms of the value that the investors see as far as the company is concerned. What is the value that they perceive as far as the company is concerned? The function of the secondary market is to provide liquidity. And an equity shareholder can easily exit from the investment by selling the securities and converting into cash. Again, if it's an exit route for a seller, it's also an entry route for a buyer, which means that the platform or the secondary market provides an opportunity to the investor to invest to generate good returns. Now let's look at the difference between the primary and the secondary market. We've already talked about the primary market is the new issuance, is the first time issuance of securities, and the secondary market as such is all the buying and selling, the trading post the primary market issuance. So it involves basically the trading of the existing securities amongst the investors. As far as primary market is concerned, the companies raise capital by selling newly issued securities, whereas the secondary market involves trading or buying and selling in those securities. The participants in the primary market are underwriters, lead managers, investors, issuing companies, whereas the secondary market involves the brokers, the buyers and sellers, that is the investors, even the dealers and so on. The primary market issue can be at a fixed price or it could be at the book built price. We've talked about the range when we were discussing primary market. Secondary market on the other hand is purely a market driven price. Nobody is really predetermining those price. The price is a result of the demand and supply, based on the buy sell orders. That's how the price is determined. In terms of the volume or the quantity of shares, there is a pre-decided, pre-ascertained volume of shares that is issued as far as the primary market is concerned, and in case of secondary market, it is a function of the demand and supply. If there are more people who are buying and selling, the volume of shares will be higher obviously, and if nobody is trading it or very less people are really trading, the volume of shares traded will be very, very less. The primary market is regulated by the SEBI or the Capital Market Authority of any particular country. On the other hand, the secondary market is not just regulated by the Capital Market Authority of the particular country, but also the respective stock exchanges in wherever the security is listed and traded. So how does really this secondary market work? So the secondary market is nothing but, as we've talked about, a platform as such. Any marketplace, a market fundamentally is a place where buyers and sellers come together and deal or trade in that particular asset class or security. So the secondary market is a platform where the buyers and sellers will all come at a particular common platform and trade in those securities. Now, where does this trading takes place? Now, if I look at fundamentally creating a marketplace between the buyers sellers, I need to have a common place. May not necessarily mean a physical place. It could be an online platform as such. Long ago, there used to be a physical place where the buyers and sellers would come together, and the buyers and sellers, of course, would come through the brokers or representatives who were authorized to trade. But now it's the online platform. So now we have the organized exchanges like the National Stock Exchange or the Bombay Stock Exchange, where the trading takes place. There are many examples, and we'll talk about it, the various exchanges, be it the New York Stock Exchange or the NASDAQ and so on. So the stock exchanges are centralized platforms where the securities are traded. And why do they do this? Because obviously there is a charge, there is a commission, there is a fee that is attached to it. The examples of stock exchange globally are New York Stock Exchange or the National Stock Exchange, the NASDAQ, the London Stock Exchange, and so on and so on. On the other hand, there is another way of creating a marketplace, which is the over-the-counter or OTC market. Fundamentally, this is a very unorganized way of dealing, as in the investors deal with each other. So it's basically the individual investors coming together. But the fundamental question remains, how does a buyer find a seller or a seller find a buyer? So there has to be a common ground or a common person who would bring these together. And here it's the job of someone called as a market maker. The market maker is a person who brings the buyers and sellers together. We will talk about it when we discuss OTC markets in detail. But the OTC market basically is an unorganized market. Let's try and distinguish between the organized market and the unorganized market, or the OTC exchange and the standardized organized exchange, to understand this better. So the over-the-counter or the OTC market is a market where the investors directly deal with each other. There is, of course, an intermediary. The element of intermediary remains in both the markets, but as such, it's not really an organized exchange. On the other hand, the exchange, the organized exchange, provides a centralized platform where all buyers and sellers can come together and trade. In the OTC markets, given the nature that these are unorganized markets, the large players, the institutions, the hedge funds are the participants really. Whereas on the organized exchanges, it's all of the large institutions definitely, but the and also really the retail investors participate here. The OTC market largely are continuous 24/7. The exchanges on the other hand have specific trading hours which are decided by the individual exchanges. The price discovery as far as the OTC market is concerned is done between the buyers and sellers by way of negotiation as such. On the other hand, the exchanges, it's basically the supply and demand which really determines the price, the volume of shares, the price that a buyer is willing to pay or the seller wanting to sell the securities at. That's how the price discovery is done. Given the fact that only two parties are involved as far as the OTC markets are concerned, there is very less transparency as such. On the other hand, given the number of players, the public disclosure of information, and as such the organized way of trading, there is a high degree of transparency in organized exchanges. Again, given that there are two, there's a buyer and a seller and it's individual counterparties dealing in that particular security, the liquidity element will be obviously lesser. On the other hand, the exchanges will provide a far more liquidity as far as the securities are concerned. And let me give you an example here to understand these aspects in more details. Now, let us take an example here. If let's say we are talking about an OTC market, we are talking about the buyer and seller coming together. There could be an intermediary by way of a market maker, and since the market maker is dealing with both the buyer as well as the seller, the difference between the price could be high. For example, if there is a security which is not very easily traded, let's say it's not listed on any exchange, there is no organized exchange for it, and if a buyer wants to find someone whom he can sell these or buy these securities from, he has to approach this common person, and in our case we'll call it as market maker. So the market maker is someone who comes in between a buyer and a seller. So a market maker will act as a seller to the buyer and a buyer to the seller, and he will provide this liquidity as far as the security is concerned. Because the buyer and seller don't know each other, very difficult for the buyer to find a seller or the seller to find a buyer, the market maker is doing that particular job. Whereas on the exchange, given the fact that there are so many buyers and sellers and all of them coming to a common platform, it's far easier to find a buyer or a seller, and accordingly the liquidity is higher. As far as the regulation goes, given the fact that there is an individual trading happening between two counterparties, a buyer and a seller, the regulation will be very minimal. There won't be much of a regulation there. On the other hand, there is an organized exchange, there will be a far better, far more regulation involved as far as this trading is concerned. The execution speed depends on the platform as such, but in case of an individual counterparty, it's the negotiation, and hence it's far more faster. And when we say faster or slower, it's not really the platform speed that we are talking about, but it's basically the number of buyers and sellers and the ability to trade easier, faster way. As far as the cost is concerned, and given that the liquidity is low, The OTC markets, the costs are higher. On the exchanges, the cost is very, very less, very minimal, and that's largely it's the exchange fees as a cost as such. The accessibility as far as the OTC markets are concerned, it's more accessible to the large financial institutions, hedge funds, insurance companies, basically large institutional players and high net worth individuals. On the other hand, the exchanges, the organized exchanges, have a larger accessibility in terms of the fact that anybody and everybody, the retail investors including, all can participate in the organized exchanges. Now let's get to a very important aspect of the secondary markets, which is basically how is this trading done? What is the mechanism to trade, or the trading mechanism? There are mainly two types of trading, which is the order driven markets and the quote driven markets, and we'll explain this in far more detail as we go along. But what needs to be understood is, when an organized exchange comes together, the mechanism to trade, how does a buyer identify a seller, or how do these two parties really talk to each other? Is there an intermediary? What is the platform? How do they really trade? Let's try and understand this with the help of, firstly, the quote driven market. And the word suggests quote driven, which means if there is a buyer and a seller, how will these two people talk to each other? It's theoretically very easy to say, okay, a buyer meets a seller, but in the world of so many players, large institutions, high net worth individuals, pension funds, insurance companies, there has to be someone who has to bring them together, an intermediary. So here's where the concept of market making comes into play. Look at the words, market making. Somebody is creating a market, market making. Who is this market maker? The market maker, and not necessarily a person, could be an institution, could be a large investment banks who want to get into this business and so on, is someone who is bringing the buyers and sellers together. Question is, why are they doing it? Well, obviously there has to be some monetary interest into it. So when there is a buyer and seeking a seller, the investment bank, or the market maker for that matter, the market maker becomes a seller for the buyer. Yeah? He is not really the ultimate seller, but is behaving or playing the role of a seller, irrespective of the fact that he does not have a genuine seller at this point. So a market maker acts as a seller to the buyer and a buyer to the seller. Now, if theoretically, if he is buying from one person and selling it to the other person, being an intermediary that he is, if he does it at the same price, then why is he doing it? There is no monetary interest in this. So there is a difference between these two prices, and that spread, or that difference in these two prices is the earning for the market maker. Let's take an example. Here you see the Citigroup shares are traded or quoted, for that matter, at 72.5 and 73.30. So this is nothing but a two-way quote given by the market maker. Now when a party approaches a market maker the market maker does not know whether the approaching party is a buyer or a seller. So the market maker is giving a quote which is a two-way quote and which reads like this: the market maker is willing to buy at 72.5 and willing to sell at 73.30. Obviously, the market maker has to buy low and sell high to be able to make the difference, which is in this case 80 cents. Yeah. So this two-way quote, which is also called as the bid and the ask, is forming the basis of the quote-driven market. The market maker gives a two-way quote for any security and thereby basically making that spread in between, but the spread, that is the difference between the ask and the bid price, the spread is the commission, is the profit for giving liquidity or for facilitating the trade, which in otherwise would have been difficult because the buyer would not have been able to find a seller and vice versa. This is nothing but the quote-driven market. On the other hand, the order-driven market, and again, the beauty of these concepts or these terms is that the word itself gives a lot of understanding in terms of what they really mean. So the order-driven market is basically a market where all buyers and sellers place their orders into a common system and thereby the best prices are arrived at. So again, in the case of quote-driven market, there was an intermediary, there was a market maker. Here, the element of intermediary does exist. There is a common platform, right? The common platform could be by way of an online system, or it could be a way where the representatives collect these orders, or a common organization collect these orders like a stock exchange and place it for arriving at a fair price for the orders to match and the buyers and sellers to trade. Yeah. So basically the order driven market collects orders from all the buyers, that are all the buy orders, and all the sellers, this is the sell orders, and brings it together into something called as the order book. Let's take an example here. What I have put here is an example of the quote or the orders of Infosys. If you look at the order book here, you have various prices and the quantity. Now if I am collecting all the buy orders from all the buyers, and those are at different prices and different quantities, because that's the individual preference. Somebody wants to buy Infosys at 1912, the other person does not want to give 1912, wants to buy it at 1911, and so on and so on. So all of these orders are collected, and in case of buyers, the best order is the one where someone is willing to pay the highest price for it, and hence the highest price is placed on top. There you see 1912.30 as the best price. On the other hand, there are many sellers. All of them again have given their prices at which they want to sell and the quantities and the respective quantities. In this case, the best sell order will be the one who is willing to sell at the lowest price. So there you see 1912 and 90 paisa. Now look at these. The best buy order is at 1912 and 30, whereas the sell order is at 90. Will there be a trade? No, there won't be, because there is a difference. Again, there will be some sort of a alteration or modification in the order, and if the seller is willing to sell it and further reduce the price from 1912.90 to 1912.30, then the trade will take place. So the first priority which will be taken into consideration for the order to match and the trade to take place will be the price. This is basically what an order driven market looks like. Now let's look at what are the advantages of a secondary market. We've already talked about this aspect being the most important one, which is price discovery. When you have a secondary market where all the buyers and sellers come together, it's far easier to get the right value or the price for the securities. Basically, price is a function of demand and supply, and the organized or unorganized secondary market helps you discover the right price for the security. The second one is risk transfer. Now, when there are issues related to company, somebody may not be very positive about it, would want to sell the securities. At the same time, there are people who have a different opinion or a view about the market as such. Please remember that markets exist because there are opposite views. If everybody had the same view, everybody would be a buyer or everybody would be a seller. But because there are opposite views, hence markets exist. Transparency. The secondary market operations or secondary market as such provides a great deal of transparency. All the listed companies are required to disclose information. There is a lot of information available on the secondary market in terms of there are how many buyers, sellers, at what price. So the entire information is available for anybody who is participating in the secondary markets for them to take an informed decision. And since there is a secondary market that is available, it helps the companies in capital raising. When a company is raising capital from only the limited source or is privately held, it has limited options as such. But going to public, raising capital is possible only because there is also an opportunity for the ultimate investors to buy and sell, which is where secondary markets come into play. And finally, because there are a lot of buyers and sellers, it provides a great deal of liquidity to the asset classes that are traded. So from that, we now move on to the disadvantages of secondary market. Volatility. Well, I think everybody understands that secondary markets or markets come with their share of volatility. Markets go up and down, and irrespective of the fact that the underlying company may not be doing bad or may not have any negative news impact, but sheer due to country risk or political issues or global issues, there can be a lot of up and down happening in the stock prices, which is nothing but your volatility and potential loss, though maybe short term, but it's a potential loss for the investors. Markets are also subject to manipulation. However, with the kind of regulations and compliances, there has been a great deal of change, and it's not that easy to manipulate a market, but it can be still done. It's there in pockets. It may be possible in certain securities and to some extent, but yes, this does exist. Counterparty risk. So the secondary market, particularly if I talk about the OTC market as such, does have the counterparty risk. When I say counterparty risk, we are basically talking about the performance of one of the counterparty and not honoring the contract. That's nothing but your counterparty risk. Limited access. When I say limited access, it basically refers to the fact that it may not be accessible to everyone. It may not be accessible to people who do not have those credentials or are able to access the stock exchanges and so on. There can be some price discrepancies as well, and that's primarily due to systemic issues or platform issues, or it could be related to different market, different time zones and so on. But again, with technology, all of this is to a large extent mitigated as well. Now let's look at a very important term which is very widely used, market capitalization or market cap. What is really market cap? So it's a financial metric to measure the total value of the traded company's outstanding share of stock. Simplistically speaking, if I were to multiply the total number of shares multiplied by the price, it gives you a number. That's nothing but the market capitalization of that particular company. So the formula is stock price into total outstanding shares. Now, there are three elements to this particular term or market capitalization, or in the calculation of market capitalization. The first one obviously is the stock price. Yeah. So every day the stock price moves up, down, whatever. That's basically there on the stock exchanges based on the demand, supply and so on. The second aspect is the total number of outstanding shares. Now this refers to the total number of the company's shares that are available to the public and held by investors, right? It includes all the common shares, right? But this does not include the insiders and those shares that are not available for trading, right? This again, outstanding shares can change over a period of time due to certain corporate actions and so on. So when you multiply the stock price with the total number of outstanding shares, the resulting number is nothing but your market capitalization. Just because we've taken an example of Bajaj Housing in our earlier sessions, the market capitalization of a newly listed company like Bajaj Housing Finance is 1.3 trillion rupees, right? You can imagine the kind of number of outstanding shares and the price that is being commanded by the stock as such. So based on the market capitalization and given certain ranges, these stocks are further divided into large cap, mid cap, small cap and micro cap. Yeah. Investors decide or take investment decision based on these segmentation as such. So large cap, as the word again suggests, are companies which have a market cap over 10 billion. Yeah. And similarly, mid cap will have a range between, let's say, 2 to 10 billion, or a small cap will have something like a 300 million to maybe 2 billion and so on. This is again a little bit relative because it's depending on different geography, different stock exchanges, different markets and so on. It can vary to some extent, but largely this is the segmentation and the ranges within which the large cap, mid cap, small cap and even micro cap are defined as such. Why do you need a market capitalization, right? So first and foremost, you are able to analyze, you are able to compare two different companies based on the total number of outstanding shares and the stock price as such, based on the market cap as such. The market cap is a very important metric because if it talks about how many shares are traded, what is the number of shares available for trading, and that could form a part of a consideration as such. That could be one of the factors for anybody to take an investment decision. There can be funds, there are investors who would want to only deal in large cap or only deal in mid cap, and so on and so on. Index composition, and we are going to talk about index as such in terms of what is an index and so on, but market cap is a very, very important factor that helps in determining the companies that are included in various indices, and there are various indices that are being calculated based on even the market cap as such. Risk assessment, well, of course, if you look at a large cap vis-a-vis a micro cap, obviously the micro cap companies, they have lower market cap, not many shares traded in the market, hence that's a riskier proposition as such. So the market cap allows you to analyze or assess the risk that is inherent to the investment decisions. Now let's look at one important concept in the secondary market, and I'm very sure most of you have heard about it, and for those of you who even trade in the markets would have heard and traded and dealt with it on a day-to-day basis, and that's your index. So what is an index? I'm sure a lot of you who are who've heard about Nifty and Bank Nifty and Nifty Metal and so on. Let's try and understand what are these really. So an index or stock index is basically an indicator of how the market is really performing. Let me just simplify this. If we were to say that every day all the stocks that are listed on the exchange, they go up, they go down, there is a change every day. How do you really ascertain if the overall market is doing well or not doing well, is going up or is going down? You can only ascertain that if you compare it with something, right? Something is up or down if you actually compare it with a particular base, and that is what an index is all about. So if I were to make a statement as in the Indian stock market is doing well, what is the basis? Well, if all the companies, their stock prices are going up, and I can also say that that's some sort of a barometer of the Indian economy to say that, oh, India is doing well. If the stock prices are going up, that means the company is doing well. If all companies do well, then overall the sector, the industry, the economy, everybody is doing well. But the question is, it's not going to happen that way, that all companies won't go up, all companies won't go down. So how do I really create some sort of a representation? Because I obviously cannot take, there are some 9,000 companies listed on a particular exchange. I can't take all 9,000 and ascertain that. So a stock market index basically is to take a representation of various industry and ascertain the movement based on the day-to-day movement, whether the markets are doing well or not, right? And we'll do a detailed calculation of how this is done. What are really these markets? Now, market index, the broad market or the market cap based indices. So the broad market based indices that are available today are your NSE index or the Nifty, which is nothing but NSE's 50 and abbreviated like Nifty, or BSE's Sensex, which is nothing but your BSE sensitive index. So the Sensex takes into consideration 30 stocks, and Nifty takes 50. So as I mentioned earlier, it's very difficult to take all the stocks. So in order to have a good representation, a good sample, 50 stocks are taken from various industries. Again, the criteria is the market capitalization. If I take the top traded, the companies with highest market cap of a particular sector, let's say pharma or cement or oil and gas, and I take that as a representation and similarly take it for all the industries, and I have a sample size of 50 and then try to compare the prices, it's far easier for me to say whether the markets are doing well or not. So market capitalization is a very important parameter when the index is calculated or when a new index composition is done. So here are some of the examples of some of the popular indices, which is your Nifty, of course, and then the Nifty Next 50, mid cap. So here, as the word itself is suggesting, the mid cap is the mid cap 100 stocks in the mid cap section, where the top 100 stocks with, as far as the market cap is concerned, are taken into consideration. And similarly, 250 stocks from the small cap or the BSE 100 or the BSE 200. Then there could be certain sectoral indices as well. If I take into consideration all the IT stocks, the Infosys, the TCS, the Wipros, the HCL Techs of the world, and create an index out of it, Nifty IT. If I take all the banks, then you have the banking index, and similarly metal, pharma, FMCG, oil and gas, and so on and so forth. Then you can have these something called as thematic indices, which is basically looking at the manufacturing or the India manufacturing or the consumption in India and so on. So based on the India consumption, an index is drawn. That's nothing but your theme for investing. Then there could be certain indices that are calculated from an investment strategy point of view. People may want to invest in only growth stocks or only value stocks or dividend paying stocks or stocks which have a low volatility and so on. So these are again indices that are designed and made and calculated based on the investment strategy that investors might want to adopt. So how are these stock indices calculated? So taking into consideration the example that I had mentioned about the representation from various industry, so index value is calculated on a real-time basis, and you can see if you're tracking Nifty, you can see it's practically changing every second, every microsecond. So it's a very real-time calculation that happens. Every stock in the index is assigned a specific weightage. It's again based on the market capitalization. So going back to my earlier talk where I had said that you take 50 stocks from different industries, but again, if I take, let us say, a Reliance Industries, or let's say I take a HDFC Bank, vis-a-vis I take a stock like ONGC, which is from the oil and gas. So yeah, two different sectors, leading companies, but given the fact that the market cap varies and varies substantially, let's say, it's very important if I were to calculate the index or the index, I need to assign a particular weight, because a little bit of a movement in HDFC Bank will have a higher impact. And to capture that, the weights are assigned based on the market capitalization. So basically, the 50 stocks that are taken from different industry, because the representation has to be there, And further than that is the weightage that is assigned to the stock based on the market cap and the impact the price may have on the overall index. Let's look at the steps. So firstly, it's the market cap that is taken into consideration. Based on that, the weights are assigned. Yeah. Again, this weight or the market cap is related to the free float market cap. In our earlier conversation, we've established that the total number of outstanding shares that are available for trading. Yeah. But a lot of times we are seeing that it's a closely held company, or the promoters tend to hold a substantial portion and they don't really trade on a day-to-day basis. So if, let's say, there is a company where the promoter holding is, let's say, 30%, right, and 70% is being freely traded, isn't it fair to take 70% as the free float or the market cap calculation? Yeah. So a free float market cap is nothing but the total number of shares multiplied by the free float factor and of course the share price. Yeah. And finally, when you calculate the price or the number based on the market cap and the free float and the current stock price, in order to compare and calculate the index, you need to compare it with the base year, right? So if I compare the 50 stocks, the representation that I took, compared to a particular year where the same stocks were traded, and kind of compare the two, it allows me to understand that, oh, the market in that particular year, the base year, was here and now it's grown and it's maybe doubled or whatever. Yeah. So example, the Sensex has taken the base year as 1978-79 and the base index value then was 100, and today the Sensex is 84,000 plus. Yeah. So you can understand and imagine the kind of change that has come into these stock prices over so many years and decades as such. So three important factors as far as index calculation is concerned. One is the composition. Yeah. Which are the stocks that are taken? That's very important. From our earlier conversation, we've established it's the representation from different industries so as to give a holistic view of the stocks that are listed on the exchange and the economy as such. Then of course the weightage, which is based on the market capitalization, and third is the calculation based on the base year and so on. And then you take a base value again. While Sensex is 1978-79, it's been there since many years and decades. If today, let's say, the base value were to be changed, and instead of 1978-79, if they decide to take, let's say, 2001, a new number will come into play, right? But we are so used to Sensex, we are so used to that number 84,000. It's very easier for us to relate on a day-to-day basis and so on. These indices are really a benchmark. So if Nifty is at 26,200 today and was 25,000 a month back or a couple of months back, you're able to compare, understand how the stock market prices have performed and so on. So the index becomes a benchmark of not just the stock prices but also the investment. So if the index, let us say, in the last 1 year has grown by, let's say, 20% or has increased by 20%, but our portfolio has grown by 18%, then definitely it's the investment manager who's not really beaten the indices. But if the portfolio grows by 25%, then we've done better than the overall market, and that's some sort of a benchmark of the performance of the fund or the fund manager or the investment advisors as such. Again, indices provide historical data. It's been calculated for so many years, so it allows you to go back and compare performances and so on. So these are some of the examples, some of the most popular indices that are available in the market today. The S&P 500, the Dow Jones Industrial Average, the Nasdaq. The Nasdaq again is an acronym really. You must go and find out what's the full form of Nasdaq, or maybe I'll keep it for a later date to give you the full form of Nasdaq. It's something to do with National Automated Stock Dealers. Find out what is ANQ. Then of course it's the FTSE 100 and the Nikkei 225. Nikkei is basically the Japanese index, and FTSE 100 or FTSE is basically the London Stock Exchange. So we've seen what an index is really and what is the important purpose, what is the reason why an index is required. So it's basically performance measurement. You can see how your portfolio is performing in comparison to something. So you're benchmarking it to the overall market performance as such, and understanding whether your portfolio is doing better or not, and so on. Then again, based on the index itself or the composition of the index, there can be certain investment products that are available. A lot of people think, and it's a very rational thinking to say that if markets are going up, if the Sensex has gone from 100 to 84,000, why do I have to do stock picking? Why do I have to think about and research what stocks to buy and what not to buy, and how do I buy and when do I buy? Why don't I just what if I just had the Sensex available to me as a product? So then there are these exchange traded funds which are available. Then you invest in a fund which exactly replicates the Nifty. So the investment is done, the entire fund corpus is put into Nifty stocks as per the market capitalization, as per the weightage. So it's exactly replicating the Nifty movement. So that's again an investment product that's available. And finally, given the fact that the index is a representation of various industries, the sectors, the overall performance, that helps the analyst and the economists to analyze the economic health, the trends, the way the markets are performing, the way the economy is performing, which is again a sign of confidence.
Found this session valuable? Hit the like button, subscribe to our channel, and tell us in the comments below what topic we should dive into next.